Welcome back to The Deep Dive, your shortcut to being well-informed. We've gone through the Q1 fiscal year 2026 earnings call, which happened after hours on January 7th, and we are ready to unpack a story of, well, some really dramatic financial contrasts.
That's putting it mildly. I mean, if you were watching the stock that evening, you went on a real roller coaster. Management kept calling it a transition quarter.
Right.
And what that really meant in practice was, weak, pretty ugly headline results right next to these remarkably strong underlying indicators. So for you, the listener, the big question is this: which signal matters more? Do you follow the messy past, or do the leading signals point to a much better future? That's our mission today.
Okay, so let's start with that initial shock. The headlines really did spook the market. The stock dropped, almost 10% in after hours at first?
It did. And when you look at those raw GAAP figures, that reaction makes perfect sense.
So what was the main number that caused the panic?
It was the GAAP EPS.
Yeah.
It came in at negative 27 cents. Just a staggering mess. The street consensus was for, a positive 3 or 4 cents.
So a 30-cent miss per share?
A 30-cent miss. When your most visible number is that far off, the market is going to punish you, and it's going to do it fast.
And the revenue wasn't any better?
No, that offered no comfort at all. It also missed, coming in at $64.05 million. That's a drop of 7.3% compared to last year.
And I think there was a third piece to that ugly picture, right? The cash flow.
The trifecta. Cash conversion just took a nosedive. Free cash flow went from a positive $11.4 million a year ago to negative $3.7 million this quarter. So you put those three things together: the GAAP miss, the revenue drop, the negative cash flow, and you get that big initial sell-off.
And yet, by the time the market opened the next day, the stock had bounced back and actually closed a little bit positive. So how do you explain that? How does the market go from panic to, acceptance so quickly?
It's because once the dust settled, investors saw two really crucial mitigating factors. The first was that all that financial noise was pretty much contained to the GAAP line, the non-GAAP EPS.
The adjusted number.
The adjusted number, right. It actually beat expectations. It came in at 7 cents versus that 3 to 4 cent consensus. And that tells you the core operational health wasn't nearly as bad as the headline looked.
Okay, so that's one. What was the second factor?
Guidance.
They didn't cut it.
They didn't just not cut it. They emphatically reaffirmed their full-year revenue and adjusted EBITDA guidance. Management was basically screaming, "We know Q1 looks bad, but this was planned. The full-year promise is still intact." And the market, chose to believe them.
Okay, let's really dig into that contradiction then, because that's the whole story here. Where did that massive 30-cent gap between the GAAP miss and the non-GAAP beat actually come from?
It was almost entirely one thing: restructuring charges. The company spent $3.4 million on costs during the quarter.
Mostly severance pay.
Mostly severance, yeah, and related costs. They were finishing this painful but necessary reorganization. You can think of it as a one-time cleanup cost. And because it's non-recurring, it gets stripped out for the non-GAAP number, which is why that one looked healthy,
right,
while the GAAP line, which has to include everything, just looked awful.
It's like they decided to take all their medicine in one quarter. So let's talk about that revenue decline, that 7.3% drop. You said revenue lags invoicing. So is this just the pain from last year finally showing up on the income statement?
That is exactly what it is. The revenue they recognized in Q1 was a direct result of lower amounts they invoiced way back in fiscal 2025. That was because of, the macro uncertainty everyone was feeling last year, plus those government contracts they canceled.
So less invoiced last year means less to recognize as revenue this quarter.
Precisely. This was baked in. It was expected. It explains the decline perfectly.
And what about the other metrics like profitability? Adjusted EBITDA was down pretty significantly too.
It was. It fell from about $7.7 million last year to $3.7 million this year. And that flip in free cash flow you mentioned.
The negative $3.7 million.
Right. That was also tied to the restructuring. That was one part. But the bigger piece actually was about $10.1 million in timing shifts with working capital. Basically, how and when they collect cash. Management was very clear that they expect FCF to improve a lot and turn positive again in the second half of the year as invoicing ramps back up.
Okay, so now we pivot. Let's talk about the signals that actually saved the stock. This is where the real investment story is. Management kept pointing to specific data to prove that this painful transition is over, and more importantly, it's finally working.
This is the inflection point. You have to look at their core engine, which is Enterprise North America. The change here is just It's dramatic. Overall, invoiced amounts for the quarter grew 7% year over year.
But the real number is even better, right? Once you strip out the government business they're exiting.
Exactly. When you exclude that drag, the growth rate accelerates to a massive 13% year over year. Now, to give you some context on that,
Go ahead.
in the last quarter, Q4 of 25, invoiced amounts were down 26%.
Wow. Down 26 to up 13.
It is a textbook, powerful turnaround. This is not some modest improvement. It's a reversal.
And they had more data to back that up, specifically on new customers?
They did. The story gets even cleaner there. New logo subscription invoiced amounts, so this is just new subscription customers, surged 25%. That's a pure metric that shows their new hunting team is really finding success.
Okay, that's compelling. But let me play devil's advocate for a second. A 13% acceleration after a 26% decline. Could that just be a one-off? Pent-up demand finally getting released? How do we know this is a sustainable trend?
That is the right question to ask, and the answer, or at least the supporting evidence, comes from their services bookings. They're not just selling software licenses anymore. They're selling whole solutions.
It's consulting and implementation.
Right. And service bookings were up 29%. This is what validates the whole strategy shift. When a client signs a big deal that has a major services component, that's a signal of a long-term commitment. It makes the revenue stickier.
So if we connect all this new invoicing to future revenue, we have to look at the balance sheet. Deferred revenue?
Yep. The balance of deferred subscription revenue grew 8% to $49.1 million. That is money in the bank, contractually secured, just waiting to be recognized as revenue in the coming quarters.
And they also talked about the length of these new deals.
They did. They pointed out that 61% of their contracted amounts are now for multi-year deals. That's huge for visibility and reducing the risk of churn. It shows clients are buying into the long-term vision.
You highlighted a small detail that I think is really important. This new idea of contractually committed services. That's a subtle but really powerful change, isn't it? It de-risks their future.
It is a critical nuance. They gave a great example, a $5.6 million commitment tied to a big agriculture deal. In the past, they would only recognize services revenue when the client actually, scheduled the consulting days.
So it was unpredictable.
Very. Now, these big chunks are committed upfront in the contract. It guarantees the cash flow, even if the actual work and the revenue recognition gets deferred way out into fiscal 2027. It just locks in the demand. It makes the future so much more predictable.
Okay, so let's circle back to that full year guidance they so forcefully reaffirmed. They're sticking with $265 to $275 million in revenue and $28 to $33 million in adjusted EBITDA. So this year is all about execution to set up for a big acceleration next year.
That's the whole narrative. And the only little tweak they had to make was about timing, not about the total amount. They hit a snag in their education segment.
What happened there?
A big statewide contract. The implementation timing on it just shifted. It pushed about $3.5 million in invoice amounts out of Q1.
Yeah.
So that revenue and EBITDA will now just land in Q3 and Q4 instead.
So because of that one deal, they had to adjust the first half profitability target a bit lower, from that 30 to 35% range down to 25 to 30%. Again, it's a shift within the year, not a cut to the year.
Exactly. And while all this is happening, they're not just standing still. They're positioning for the next wave of growth, which is, of course, AI. They talked a lot about their new AI-enabled offerings.
Like what, an AI sales coach, I think?
An AI sales coach, an AI coach for their 4 disciplines of execution platform.
Yeah.
But the strategy is key here. They aren't trying to build the next ChatGPT.
So what's the angle?
Their angle is the human side of AI adoption. They're building the consulting and training services around it. A new solution they mentioned is called Leading AI Adoption. It uses their expertise in behavior change to help companies actually get their people to use these new tools effectively. That's a high-margin service they can bundle into these multi-year deals.
And what are they seeing in the broader economy? Are their customers starting to open up their wallets again?
They called the backdrop mostly neutral, which is definitely better than negative. They said budget pressures are still out there, but they're absolutely seeing those early signs of discretionary spending coming back. That's what's fueling that 13% growth.
And they're targeting specific industries to capture that spend.
Right. They mentioned healthcare, for instance. About 17% of their revenue comes from there now, and they're building out teams specifically to go after more hospital deals. They're focusing on solving really specific problems, like nurse retention, that have a clear ROI.
So the biggest risk is clearly execution. But the safety net here is their balance sheet. It's solid.
Oh, liquidity's not an issue at all. They have about $80 million in total liquidity. That's $17.5 million in cash, plus a big $62.5 million undrawn credit facility. That gives them a huge buffer.
And they're using that financial strength to buy back their own stock. Aggressively.
Very aggressively. They bought back about 624,000 shares for $11 million in Q1 alone. But the really important signal was the 10b5-1 plan.
Explain that for a second. Why is that specific plan so important?
A 10b5-1 plan is a pre-scheduled automated buying plan. It basically tells the market, we set this up in advance and we believe our stock is undervalued, so we're going to keep buying no matter what the short-term news is.
Yeah.
They started a $20 million plan in November and expected to be finished by the end of this month, January. It's a huge vote of confidence.
So given all this, what's the Wall Street consensus now? It sounds like there's a split.
There is. You have the sell-side analysts, like Barrington, who are buying the story. They reiterated their outperform rating and a $22 target.
Yeah.
But the broader consensus, what you see on Market Beat, is still a bit more cautious, more of a hold rating, though with a higher average target around 24.50.
So it all comes down to the next quarter.
It all comes down to execution. Can they take this amazing momentum in new logos and invoicing and turn it into clean revenue and positive cash flow in Q2 and Q3? If they can do that, they'll hit their guidance and the skeptics will have to capitulate. That's the whole game right now.
They took the pain, now they have to show the gain. Which, of course, brings us to our favorite part of the deep dive. The "this is not financial advice" segment. Given all this volatility, the clear inflection point, and management's aggressive buybacks, what is the outrageous but plausible trade idea here?
Okay, so the bet here is on the conversion of that execution risk, that 25% new logo growth and that $20 million buyback.
Right.
What that's done is it bought management about 3 to 6 months of credibility with the market. So the trade is this: a highly leveraged, short-term, slightly out-of-the-money call option that expires right around the Q2 earnings release.
An options play. I like it. Walk me through the exact rationale there.
This trade is a pure bet on that North America invoiced amount number. If Q2 comes out and confirms the acceleration, let's say growth is in the double digits again, proving Q1 wasn't a fluke, the good news is going to have an outsized impact.
Because the buybacks are reducing the number of shares out there.
Exactly. The buybacks amplify the good news. That kind of confirmation would force a really sharp rally back toward those analyst price targets of 22 to 24.50. And because you're using a leveraged OTM call option, that kind of sharp move, capitalizing on that upside surprise, well, it could result in a significant return. It's a high-stakes bet that management can deliver.
A confident bet on execution. So, to wrap up this entire deep dive, the Q1 numbers were messy, there's no doubt about it. But that mess was mostly due to one-time restructuring costs and a predictable lag from a tough 2025. What it obscured was the reality of some incredibly strong leading indicators.
Indicators like 13% invoice growth in the core business and 25% new logo growth. These numbers position the company exactly where it needs to be for a powerful acceleration into the second half of this year and, really into FY 2027.
A perfect summary.
And so here is a final provocative thought for you to chew on. Management clearly laid out the plan. FY 26 is for execution. FY 27 is for acceleration. They have that $62.5 million revolver just sitting there undrawn. They talked about it, but they chose not to use it for even more buybacks in Q1.
Right.
So my question for you is this: what level of continued invoice growth in Q2 would it take for them to change their minds, to decide they need to pull down that cash and get even more aggressive with returning capital to shareholders? And on the flip side, what stands out to you as the single biggest risk to this whole back half loaded story?
An excellent question to consider. Thank you for joining us for this deep dive into the Q1 FY 2026 earnings call. We will catch you on the next one.